Hi everyone, my name is Lucian. Most of you know me from Twitter as Triangle Investor. Today I have a very interesting guest, that is Nick Hodge. Nick is from Resource Stock Digest. Welcome, Nick.
Lucian, thank you very much for having me. It's a pleasure to be here, and I enjoy following you on Twitter, which is where we were able to connect.
Thank you very much. Nick, I would like to start with your background. Can you share to my audience, give us a short introduction of yourself? When did you start investing in commodities, and which commodities, with which commodities did you start?
Sure. I started in the newsletter space, the financial newsletter space, right out of college. That was going back to 2007 now. So I got a really fast education in black swan events and what can go wrong in markets, because I was hired to write about clean technology at the time, which was a really big theme in 2007 with Al Gore and the inconvenient truth, and small solar stocks in China going up very fast, and then the bottom sort of getting pulled out of the market. So I cut my teeth on clean tech, analyzing and writing about and investing in solar and wind and geothermal. And then I saw what gold did on the back of the global financial crisis. After 2008, I saw how gold responded, and I started digging into why. Looking at things like the Federal Reserve and how it was created, and monetary policy, and I was able to get some really good mentors who happened to have extensive backgrounds in the commodity space. And so I guess I first gravitated to gold after 2008 as the first commodity. I know some people don't like when you call gold a commodity, but that was the first commodity I gravitated toward, was gold. And then I started, building my network and developing my connections in the space. And it wasn't too long before I developed an affinity for nuclear energy and uranium. One, because I came from a clean tech background, and so I recognized very early on that nuclear was a clean and safe technology. And then I started to learn about the supply and demand fundamentals and realized that, like Rick Rule says, it's a when, not an if. And it's been a long when. Here we are in 2023.
Yeah, definitely. But you still believe that we are in early days of commodity super cycle. Did anything change with that view for you?
No, I think a new commodity super cycle recently kicked off, sort of amid COVID in 2020. We had a bottoming of the CRB commodity index that really took off sharply in 2021 and 2022, and then sort of peaked in late 2022 when inflation peaked. So I think we're very early in the commodity super cycle. And if you look at the last, and when I say commodity super cycle, I'm talking about the CRB index. I'm not talking about uranium. I'm talking about oil and copper and nickel and all the commodities, right? The last one lasted from the early 1990s until 2007 or 2008. So, 2-decade run is a super cycle, and we just had one that kicked off 2 or 3 years ago. So it's very early days. And if you look at the previous cycle, the chart of the CRB commodity index, you'll see that it had significant consolidations and retracements during that 2-decade ascension. And that's what you're seeing now, right? You've had some extraneous factors like inflation cooling that, brought oil down from above 100 to $70 a barrel. Obviously took copper down from well above $4 to below $4. And so it's been a healthy consolidation. And over the past few months, you've seen the commodities start to tick up again. So it's still very early days. I think 2 or 3 years into what will eventually be a 20-year cycle when we look back.
Yeah. Good point. Can you tell me what are the top 5 commodities that you are most bullish on?
Oh gosh, I should have made a list beforehand. I'm very bullish on gold at the moment, because of the monetary policy decisions that have come over the past years, because of the ongoing devaluation of the dollar, because of the low interest rate environment that I believe we're going to return to after the current hiking cycle. That's one. Very bullish on copper in the long term. There's a structural supply deficit. It's, one of the most critical metals for the greening of the economy. There's been known shortages. I'm not breaking any new ground here or telling your audience anything that they don't know. Very bullish on uranium, obviously. That would be 3. Pretty bullish on the PGMs in the long term, which I'm not sure many of your guests talk about. So that's 4. And then, gosh, let me give you a weird one, because a lot of people would say nickel or tin or something, but I'll tell you the 5th one is helium that I'm bullish on. It's a unique situation in the US where they sold down their strategic reserve, and the price has gone up from $100 or $200 an MCF to companies now signing deals for several $100s per MCF, and still not a lot of new supply coming online. And I like that because it's not a clean energy transition storage. It's needed for a lot of things: medical technology, rocket launches, manufacturing semiconductors, which there's an ongoing shortage of. And so I don't think helium gets a lot of attention, and so I'd add that there's the 5th one.
Okay, what about your bearish side? Is there a bearish side when it comes to commodities? I mean, in the long term. Can you name 2, 3?
Yeah. You said the long term. Let me give you a caveat that silver I've been pretty neutral on, I would say, for the past couple of years. And I guess being neutral on silver kind of is bearish when you put that against all the hyperbole that's out there in the silver market, with the Reddit crowd and the silver going to the moon and all this talk that's out there. And I guess there's that with the retail crowd and uranium as well. But I've been saying for over a year that silver wasn't going to the moon like a lot of these folks were saying. And sure enough, although it's at 25 or 26 bucks here recently, silver has not gone to the moon. And then gosh, what else am I hear a lot of stories about tin. I'm not convinced tin is a long-term sustainable story. So there's 2.
Okay, thanks. I would like that we talk more about uranium. What kind of uranium plays do you prefer? Is it the explorers, producers, or developers, or the ETFs?
I really should have made my list, because I didn't tell you lithium. I didn't tell you lithium in my 5 bullish commodities, so I have to go back and add that on. But how do I invest in uranium? I invest across the spectrum. So I made a list of my holdings. That way I could talk about them with some perspective. I own the entire curve, and I do that through ETFs. I own, Sprott ETF, not the SPUT. I'm talking about like the URNM, which itself owns some physical uranium. So I do have exposure to the physical. I own late stage developers like Encore Energy that are getting ready to come back online in Texas with ISR production. And I didn't buy them outright. I became an Encore shareholder because they bought a company that I was invested in called Azarga Uranium in a share deal. And so that's how I got shares of Encore, which I continue to hold and am bullish on. I own names like prospect developers that aren't necessarily pure exploration, but get a little bit of either payments or catalysts in the form of other companies drilling their projects. I know you recently had on Jordan Trimble from Skyharbour. That's one of my longest uranium holdings. I've been involved in that company since a very early stage. I participated in multiple private placements, and I think Jordan is really switched on when it comes not just to the uranium space in a macro sense, but also in the North American, especially the Athabascan, obviously, the uranium situation. He's become a very large land holder in the basin, has strategic, backers and partners in Denison, which I know you had David Cates on recently as well. And they just have multiple shots on goal, and they don't need to raise money because they've got exploration being funded on other companies' dimes. So tens of thousands of meters of drilling you'll see this year from partner-funded projects, and also from Russell Lake, which they recently optioned, and they're drilling 10,000 meters there now.
Yeah.
I'm just looking at my. Go ahead. You have another question? Or you want me to keep talking about companies?
No, we can discuss furthermore about the companies. You mentioned Denison. Do you own Denison? What do you think about Denison mines?
Yeah, so I do own Denison. I own Denison and Energy Fuels equally. And I didn't buy those positions until recently. So, I just talked about Encore and Skyharbour, which I've owned for, I don't know, 5 to 8 years, let's say. But Denison and Energy Fuels, I started buying this year when everybody was really pessimistic in March. And they simply got too cheap to ignore. Denison got down to around a dollar US. And so I started buying, and I recommended Energy Fuels in my letter. I like both those companies for similar as well as different reasons. I like the fact that they're listed on a major exchange, which a lot of these, developers and explorers aren't. I like that they're liquid, so I can get in and out when I want. I like that they have exposure to things that aren't just obviously drill hole plays, right? Denison has the exposure to the mill up there in the basin. Energy Fuels has its own mill as well, and it's not just uranium with Energy Fuels either. I like that they can extract rare earths and vanadium from their mill as well, and so I get exposure to other commodities that are sometimes tough to get exposure to, or certainly tough to get liquid exposure to. And so I can just look at my Energy Fuels and say, oh, I have exposure to rare earths, I have exposure to vanadium, and I can look at Denison and say, I have exposure to mill, to processing, and I have exposure to potential new extraction technologies. They're working on their essentially in situ for hard rock deposits, which I think could be game changing. So I wanted some exposure to that.
Yeah. What about the other two U.S. Near producers, Anfield Energy and UEC, Uranium Energy Corp?
I haven't spent a lot of time with Anfield at all, so can't speak to that. UEC I don't currently own, but I have owned on and off for the past 10 years. I think we took profits on it last year. You remember, sentiment got very bullish in 2022. The stocks were running, and I took that opportunity to sell some UEC. And I've been looking at it recently. They had that short report a couple of months ago that knocked it down a little bit, but it's a well-run company. I've been to site in South Texas. I've been to their hub and spoke, processing facility in outside of Corpus Christi, and I've known Amir for a long time. So I do have good things to say about UEC. And while we're talking about, I guess, the Adani sphere of companies, I have just a tiny position in Uranium Royalty that I took earlier this year as well, just because I like the royalty model. And it's probably a bit early for it in the uranium space, but we're all early in the uranium space, right? We're all waiting for a big run like we saw obviously in 2007, 2008. And so I have a little bit of the royalty tucked away.
And what about some Athabasca, also, let's say, near producers, but they are not so near, Nexgen and Fission?
Yeah, so Fission was the first uranium company I bought. That was probably 10 years ago. That's when they were really discovering and learning how big Patterson Lake South was. And then there sort of became this, not a feud, but it was, you had to basically pick a side, it felt like, in the uranium space for a while. You were either a Fission guy or a Nexgen guy. At least that's how I sort of remember it. And I was firmly in the Fission camp simply because I had known Dev and I had been to site, and I just had never been really introduced or gained rapport with the Nexgen camp, though. Arrow is obviously a fantastic deposit, and I wouldn't blame anybody for owning it. I've sold out of most of my Fission, but I own a tiny piece. It's probably my smallest, uranium stock by position that I own. But both world-class deposits, right? Hundreds of millions of pounds in the ground. We'll see about the development challenges with the lake, et cetera. But those are sort of, in situ reserves that you can own. They're there, they're proven, they're not going anywhere, and they're almost, can function as a barometer of the uranium price, which we haven't talked about, by the way, which is, doing quite well.
Yeah, definitely, we will. And what about small cap under $100 million companies? Let's say uranium explorers, for example. Do you own Baselode or F3 Uranium or similar companies?
No, I've looked at both. Obviously, I know Dev and F3, and they're a sponsor of my website, Resource Digest, but I don't own it. I've looked at Baselode, but I never bought it. I didn't like the way they were reporting results with the scintillometer and not the true assay, and it just didn't sit right with me. So I never bought shares. Skyharbour, we mentioned, is a smaller company. I own Latitude Uranium. It was Labrador Uranium, recently changed names. Participated in a couple of early financings for that company. It's taken a while to get off the ground. They've had some changes in management, but I think they finally got all that sort of squared away, and they are now drilling, funded to do so, and they have new leadership. That's a smaller explorer that has some good ground. And then the smallest one, and then we've covered almost all of my uranium holdings, is Kraken, and that's simply because I wanted some additional very small cap, tight share structure, North American exploration, and those are some Nexgen guys that are there running Kraken, and they're drilling now as well in Nevada, and so that's probably the smallest uranium company I own.
Yeah, it's around, I think, if I'm not mistaken, around the 30 million market cap at the moment, or even less.
I think it's less.
Yeah, sorry, maybe 15. Yeah. Sorry. Canadian, yes. And you touched on Latitude. I had John recently also in my show. He seems like a great guy, and they will put, I think he told me, like 12 million this year in the ground. So good numbers, definitely.
Yeah, good chance for results, right? Which is obviously what you need in these smaller companies is catalysts and news flow, and so they should be delivering that.
Yeah, definitely. What kind of returns do you expect from these uranium companies? Of course, depends on the size of the company, but let's say, what kind of returns do you expect from a lower cap companies?
Let me say first that there's been opportunity for gains in the past couple of years. I mean, I have made money in the uranium space. I mentioned that I sold UEC, that was over a double. I mentioned that I own Encore because they took out Azarga, and I owned Azarga because Azarga took out a company called URZ that I was in even before. And so right, these returns that I've already generated for myself and my subscribers are, a double to 300, 400, 500%. Without the sort of, $100 a pound uranium price that people are calling for. So it's been possible to make money in the market. Going forward, there will be a time when you see thousands of percent gains among these small cap uranium companies, and like I say, my crystal ball is broken. So, and maybe you can talk to Rick or Warren or one of these other folks that you've had on your show about what the specific catalyst is going to be that, sends uranium higher. But we're working our way towards it. Thousands of percent gains are going to be had in the uranium space. And while I can't say what the specific catalyst is going to be that's going to set those loose, what I can say, and what many others will tell you, is that the fundamentals continue to improve on an almost daily basis. The sentiment continues to improve among, non-resource investors, specifically among environmentalists. And we continue to see this energy transition experiment play out in real time, where all the failures maybe not all the failures, but you can see how many of the signs are pointing toward nuclear having to be adopted in a very big way. And I won't recite all the list of fundamentals that many of your audience will know: SMRs, supply deficit, et cetera, et cetera. But it is coming, and I see utilities coming back in the market to buy. I see a tight supply demand balance, and while I'm not sure it's going to be as explosive as you saw when the Cigar Lake flooded all those years ago, I do think you're going to see thousands of percent gains across the board, right? And that's one of the things that's been drilled into me by mentors of mine and folks that have made a lot more money in the resource space over many more cycles than I have, is that when the cycle comes, they'll say they make all their money in 2 years out of 10, or 2 years every 15 years, right? And but when that cycle does come, all the turkeys fly, or all the stocks go up, and we'll be arguing about, your stock is up 1,400% and my stock is up 1,600%, right? And the difference between those boats that the tide is pushing up is the ones that are going to do the best are the ones that have the best share structure, and the one that have funded themselves the best and set themselves up for the most long-term success. And those are the companies that I try to find and buy and hold.
Yeah, you mentioned Warren, but I don't think Warren would agree that we will see a 1,000% gain. Definitely, he's more of a cautious uranium bull, I would call him.
Mm-hmm.
Yeah, but he's a great guy also. I want to touch on uranium company CEOs. Can you name maybe 5 again, top uranium CEOs that you respect the most, or you think that they are doing the best job?
Gosh, can I name 5? Let me see. In no particular order. I'm just going to.
Okay.
We talked about Jordan. I think Jordan is a great young rock star and up and comer. He's done very well to strike deals to get properties from real companies. Optioning properties from Rio Tinto, et cetera. And he's done well to then vend those deals out, some of those properties, right, to attract other companies to joint venture those companies with. And he's done well to fund the company, to keep the share structure intact. And so Jordan's done a really good job. A lot of people will say they don't like the way Amir runs his companies, but from a marketing and liquidity standpoint, and from an execution standpoint, I think Amir does a great job. He's got many companies that he runs on the gold side, the precious metal side, and the uranium side, and he continues to do spin outs. He continues to build value, and he continues to market, which some people think is a 4-letter word in the resource space, but you need to attract eyeballs to your story. You need to have that to have liquidity, and Amir has been really good at that for a long time. Paul Gordonson, I think, is a great leader at Energy Fuels. You've had him on your show. He's a no-nonsense sort of character. He's building things. He's a builder, and he's getting things done. So the execution out of Encore has been great. Let me see. I'm going to have to use my phone a friend here to make sure I get some names right.
What about some, we didn't touch on the African names, Global Atomic, GoviEx, Uranium.
Well, so listen, that's interesting. Well, I looked this up here, is I don't invest in African stories. Here's another name I'll throw in there for you is Daniel Major, who I know you've interviewed as well. And I've looked at GoviEx a lot, and he's also now getting involved in another story I followed for a while called
Leading Edge.
That's exactly right. Leading Edge, which is an interesting company, interesting assets for sure in the rare earths and graphite space. But Daniel Major, I think, is a great leader. I've been on several panels with him. He knows the space really well. I'm just not keen on Africa as a jurisdiction, and you've seen some of that recently. Like I think it was Namibia who said recently that they wanted to take larger stakes of new projects going forward, and even Global Atomic had some issues in the recent months.
But it was resolved very quickly in 2 weeks.
Yeah, their share price wasn't resolved very quickly.
No, it bounced back again. But yes, I understand what you're saying. Yeah, sorry.
Right. Yeah, so the gentleman's name I was looking for was Grant Isaac. So he's not the CEO of Cameco, but he is the executive VP and chief financial officer. So
Yeah.
I don't know if you've ever heard him speak or listened to podcasts that he's done, but his name has been getting out there recently, and he's one of the most insightful executives that I've heard in the uranium space.
Yeah, I heard him speaking a few times, and I agree he's very smart. Okay, let's wrap it up with uranium. I want to touch a little bit on gold. What do you see next for gold equities? Recovering soon or more pain ahead?
Let's talk about gold first, and then we can talk about gold equities because they're two different things.
Yes.
Gold is bullish. The range recently has been sort of, high 1800s, low 1900s to essentially 2000. And it's knocked on the door a couple of times to try to break through that all-time high just north of 2000. It's been an interesting time with inflation and Federal Reserve interest rate hikes, which we'll get another one of, I'm sure this week, as soon as you and I are finished recording here. Yeah. And that's eventually going to come to a halt. Let me say that I haven't been one of these guys that's been out there for a year saying that the Fed is going to pivot, right? I've heard that for a year now. And I was saying last summer, they're not going to pivot. They're going to keep hiking. They're not going to pivot. They're going to keep hiking. I think now gold is finally sniffing out the end of this rate hiking cycle, right? There's almost 100% chance you get another quarter point hike this month. There's greater than a 50% chance you get even another hike in September. And then after that into 2024, I think gold is starting to sniff out an extended pause and or a cut in interest rates. I also see a lot of distrust in the global financial markets. You look at situations like Russia and China, and you hear this talk about de-dollarization, and I view that as a narrative, but it is something that is ongoing. Major trade nations, resource nations, looking to skirt the U.S. dollar in some capacity, and for those trades to settle, for there to be a schematic where some sort of non-dollar trade can occur, I think gold has to come into the settlement in some way. And then back to the yields for a second. I think you see a softening of the 10-year yield, which is ultimately what I look at in relation to gold. I know there's an inverse correlation with the dollar, but I don't think that's as strong as it is with the US 10-year yield. And so I don't want to get too far in the weeds, but we have a yield curve that continues to be inverted, and the reason that is because the short end of the curve, the 2-year, is high, because that it sort of is in line with what the Federal Reserve is doing, and they've been raising rates. And then the longer term end of the curve, the 10-year and the 30-year, for example, they correlate more with the long-term view or sentiment of the economy. And so they continue to remain lower than the short end of the curve, because the bond market knows that the fundamentals underpinning the global economy remain weak. You've got Europe in a recession. You've got the service economy and the manufacturing economy in Germany and the UK and France in contraction. And so I think those bond yields, those longer term bond yields, continue to weaken into 2024. And so I've been buying gold itself. I have gold in the safe, and I buy GLD. I know some people don't like that, but I've been buying that for about a year now. And then the equities I've been scaling into more over the past 6 months. So I started buying royalty companies last fall, right when inflation sort of peaked and gold started, going back up. And then I've been adding miners this year. Newmont I've been buying, Agnico I own. And then now I'm starting to go further down into the development companies, the ones that are already permitted, that are, constructing their mines now, because I think those mines are going to come online at a time. Well, first of all, they're in the right part of the Lassonde curve. But second, I think they're going to be coming online at a time when gold is at 19 or 2,000 or even $2,100. And so the $1,600 or $1,700 that they used in their economic studies, they're going to be leveraged too. And so near-term developers like Artemis Gold, for example, which has the Blackwater deposit in British Columbia, I've been recommending in my letter, and I've been buying personally. And I think gold is in a range. So I've been telling subscribers, gold at $1,900 is a buy, and it's going to run back to the high 1900s and try to knock on the all-time high door until it does. And so I think it's got good support in the high 1800s, and I'm a buyer on pullbacks in gold and bullish.
What about copper? What's your take on copper? Both short-term and long-term.
Yeah, short-term copper's tough because it's the doctor to the global economy. And so I was just talking about how there's softness in the economy, and that's one of the reasons you've seen copper come down below $4. I was giving a talk in January in Vancouver, and I was saying it's what I was telling you earlier. It's early stage in the commodity super cycle, but that there's going to be ebbs and flows. And we're going to see some of that this year based on the slowdown in the economy that was forecast. Now, recession in the US hasn't materialized. GDP growth has been, kind of stagnant, but it's not been negative. But other places in the world, like Europe, which I mentioned earlier, have been soft. And the Chinese reopening has been lackluster as well. They're already talking about, new forms of stimulus in China, having just reopened a couple of months ago. So all that sort of lackluster growth has meant that the copper has been subdued below $4. And so I've been correct on that call. Longer term, though, I think copper is exceedingly bullish. And you don't have to take it from me. I mean, go listen to a talk that, Robert Friedland gives or something like that. And I've been a great beneficiary of Ivanhoe Mines over the years. That's been a great story. But, I think in 3 to 5 years, you see $7 to $10 copper, right? I don't see a lot of quality assets coming near term online. And so I think there's a lot of early stage developers and advanced explorers that are going to do very well in the coming years in the copper space.
Yeah, agreed. What about the broad market direction for the remainder of the year? How do you see that?
I didn't hear the question. What market?
I mean, broad markets.
Oh, the broad market.
Yeah.
I've been bearish for a while. And in the monthly letter I wrote this month, I continued to be bearish. Of course, you could argue that that's been incorrect. Stocks have been going up since last October, the S&P I'm talking about. It's largely been driven, though, by a small subsector of the tech space. Everybody knows these group of 7 stocks that has been driving the S&P higher, and the phenomenon of AI that has, propelled NVIDIA and Microsoft, Google, Meta, et cetera. But the fundamentals, haven't added up. When I look at the corporate earnings for the S&P for Q1, they were negative. For Q2, they'll likely be negative again. We're in the middle of Q2 earnings season right now. There has been some wins in tech stocks and some of the bigger banks, but those bigger banks, the reason they're doing well is because banks failed in the first quarter, and they were the net beneficiaries of capital moving from smaller regional banks into larger banks like JP Morgan, for example. But when I look at PMI numbers, when I look at manufacturing PMIs, they are going down. When I look at the Conference Board Index, it is trending down, and they are still forecasting for a recession. When I look at the consumer, they are increasingly strapped, burdened with liquidity constraints, with high credit card debt, with high credit card interest rates. And the same thing really in the mortgage market, with the 30-year mortgage rate over 7% in the US. So there's not a lot for me to get fundamentally bullish on. We have had a good run. I mean, the market's up, whatever it's up year to date, 10-14% or something like that. But I don't see the fundamentals behind it driving it. And someone could point to the scoreboard and say, yeah, but you're wrong. The price has been going up, and the price is the only thing that matters. And I get that to some extent, but I can also yield 5% sitting on cash, which I continue to be in about a third of cash, and let the economic cycle play out. So you've got a Fed meeting this week. You've got also a GDP release from the US this week. I think it's going to be closer to 0% than 2%. And so I'm not sure how much more steam the broader market has in it. Now, I'm not calling for a crash and the end of the world tomorrow, but what I am saying is that the valuations on the broad market equities are well ahead of the fundamentals, and I don't see the fundamentals improving for at least another 6 months. I talked about the yield curve earlier. It remains inverted, and the recession hasn't come. So either the yield curve, which is forecast all the recessions going back for 6 decades or something like that, is wrong, or it's not. But I think the fundamentals are such that they're not going to be able to propel stocks much higher in the second half of the year.
Okay. You are participating in private placements. How that works for you? Are you in it for the warrants, or can you expand a little bit on private placement? What draws your attention the most?
Sure. No, I'm not a warrant flipper. And I know that, warrant flipping can be a successful strategy. I know folks who do that. But I don't flip stock just to clip the warrant. That's not what I've been about, and I am not in that game. I'm looking to get into quality companies with quality management that understand the capital flows and understand share structure, and are in it for the benefit of all their stakeholders or shareholders. I want to be in it early, obviously. The earlier, the better. But I want the share structure to be, tight is the word that you use when you talk about share structure. I don't want to come into a deal where it's being set up like a lifestyle company, right? Where there's millions of founder shares out at a fraction of a penny. And there's you don't know where those shares are held is another thing with Canadian companies. Those shares can be held in a numbered corporation, or the CEO has him in his cousin's name or something like that. So I do a lot of diligence on share structure when I'm evaluating these deals. And that's probably my number one metric, is I want to know where the shares are, who they were sold to, and at what price. I want like the full cap table, and I want to know that the insiders are participating and are reporting. They're reporting shareholders in their deals. Those are that's the fundamental thing I look for. Asset is important, obviously. I don't want a moose pasture. I don't want a project that has been renamed 5 times in the last 25 years. And, it's some project that has been drilled out multiple times by various entities. And now it's, now we're going to do some geophysics and we're going to identify new targets or whatever it is. And to evaluate that, you really have to have a network. So when I say that I look for those things, it's not like I know every property in the world, obviously, that has been tossed around between junior resource companies. That's where a network comes in, right? Other newsletter writers, other financiers, CEOs that have been in the industry for a long time that you can ask these questions to, right? And sometimes I think that's what the retail audience doesn't understand is the way that the industry works like that, where some of these companies are set up only to mine shareholders, never to mine anything that's in the ground, right? And you've got to be really cognizant about what those red flags are, right? So a very loose share structure, shares that you can't track down. You know, if management doesn't know who owns the shares, they can't tell you. You know, if it's something that's been around for a long time, that's been rolled back multiple times, you want to look at the previous, you know, share consolidations. How many times have they done that? And you know, what were the consequences of that? And so that's really what I've honed in on the in the past decade of learning, and I'm still learning every day, the commodity space, and specifically the junior resource space in Canada, where a lot of these companies are listed.
Yeah. Nick, I want to thank you for being my guest. It was a great. I enjoyed in your company, and I hope you will come back again sometime soon.
Same, Lucian. It was a pleasure to be on your show. I know it's a recent endeavor for you, and so
Yeah.
I hope it continues to go well.
Me too. Thank you very much.
Thanks.